What is the Fib 5618 trade? Well, good question. The Fib 5618 trade is the Fibonacci retracement tool pulling back in a trend to the 50 to 61.8 level. Now, it is also, I gave it this name as in testing, for testing out this strategy and for testing out how effective it was. And it's highly effective as long as the market aligns with other confluences as well. And like I said, this is a trend-based strategy. And so that's how it got its name. Here's some examples of bullish price action candlestick patterns. Now, these are the main ones. The first one I'm going to go over is the bullish pin bar, commonly called, and with other names you could call it the hammer or a bullish rejection candle. Here's another example of another type of candlestick pattern called the doji. Right? Now, all these patterns are patterns that are significant, patterns that can actually change the market. Right? Now, this is an example of a bullish doji. As you can see, there's a bit of green there. The next one we'll go over is a bullish railroad. Now, this candle doesn't have to be as big as the previous candle, it just has to be close. The next candlestick pattern I want to go over is the bullish engulfing. Now, this is an important one because I want to highlight something here. There are two types of engulfing candles out there in the Forex market. There's one that you see quite commonly that engulfs the complete previous candle. And then there's the second type, which is the one that is not discussed as much, which is just engulfing most of the previous candle and engulfing the high. Okay? You've got to remember these are description words of candles. Okay? And so therefore, the engulfing candle for bullish can be one that is just engulfing most of the previous candle and the high as well. Or engulfing completely the previous candle and the high. The important factor is it needs to engulf the high of the previous candle body. And as you can see, this is the body, right? This red zone. Okay, and this is the green zone. That's the green body. And when those two align and they come up to important zones, they are good bits of price action. Same with going with the bullish pin bar. Doji is an indecision candle, for all those that are wondering. It's what precedes a doji. That's important. A railroad is a very powerful reversal candle as well. So this is some common bullish signals. And here is 4 of the main ones that you want to be able to recognize on the Forex chart. They're always there and they're very common. The next lot I wanted to go over is the bearish candlestick price action. Now here's an example of a bearish pin bar, right? Sometimes called a shooting star or sometimes called a bearish rejection candle. Now here's an example of a bearish doji. As you can see, this last one is in black, right? And that's an indecision candle. It's what precedes the bearish doji or the bullish doji in the previous example that makes a difference. It's what tells you where the market's going. So it's like a doji, then an engulfing candle, and then, or doji, and then a bullish candle, and it gives a clearer direction from there. Okay? Okay, and the next example is a railroad. And this is an example of a bearish railroad. And as you can see, this bearish railroad, or basically you could almost call this a bearish engulfing as well, because you can see it's engulfing this previous candle. And that's the example of a railroad. It's basically the candles are basically the same size, or around the same size. They can be a little bit different in size. This is a common pattern that you see at reversal zones in the market as well. And here's a bearish example. You're expecting price to go lower. Last one is the bearish engulfing candle. Now, just be aware, there are actually two types of bearish engulfing candles, like I said earlier with the bullish engulfing candle. One that engulfs the complete previous candlestick, which is this green one, previous candlestick body, and then engulfs the low. And there's one that engulfs most of this previous bullish candle here, and the low as well. The important factor is that it has to engulf the low, therefore an engulfing candle, right? Okay. Now it's important to understand that we do not need to be as fussy with candlestick price action when we have many confluences such as structure and the 50 to 61.8 Fibonacci retracement tool lining up. However, we should still be aware that the engulfing candle is the strongest form of candlestick price action, and then the second strongest is the pin bar candle. Now, for all those that have gotten access to the Engulfing Trader training series, you'll be completely aware of the engulfing candle. And we all know from that series that it is one of the strongest in the Forex market. is actually the number one candlestick price action in the Forex market. And it needs very little confluence. The pin bar, on the other hand, needs a little bit of extra confluence, but it is second. Still a good price action candlestick pattern. Right? So here's some examples. A better candle just means high probability. However, even a normal bearish candle is fine when all other confluences line up. So let's have a look at an example. Here's price coming up at just recently and hitting the 61.8, and then there was a bit of a bearish candle, and then the price fell lower. Now, what I mean by normal bearish candle, right now there is a particular way of trading this, and I'll show you this on the live charts as well. We always want to sell as it breaks the low. If we're just trading a normal bearish candle, it's important that the low has to be broken on that daily candle or whatever time frame you're trading. Okay, daily just as an example. So as an instance, if price broke below here, then this would be a sell opportunity. Place going, stop loss coming up above, and we'll go over that in a moment. But as you can see, there are multiple confluences lining up. Now I want to give some examples of confluences in this trade. There is structure, right? Now you can't see to the left here because we don't have a full chart here, but there was structure here. And there's also candlestick price action, and we also have the 50 to 61.8. So three key major influencing factors that move the market. All right, and this is a downtrend. And the same goes for a better candle, just means higher probability. However, even a normal bullish candle is fine when all other confluences line up. Now let's look at another example. This is an uptrend. Price is moving up higher. Price pulls back into this zone between the 50 to 61.8. We get some nice pin bars. You can see this is a nice candlestick pin bar. This is a nice engulfing candle. This is another pin bar here. And this is also the 61.8. And see how the market reacted when it got to the 61.8 zone, in between the 50 and 61.8. Took off, right? And continued in that trend. And there are other confluences. Now I know you can't see that in this example because we can't see far back on the chart, but there were other structure points right here. You can see a little one here, but there's also structure points back in the past. And there was also good candlestick price action as well. So multiple reasons to enter the trade, right? Now you're probably wondering where to place stop losses. Now we went over that in the video parts. However, let's go over it quickly again. And there are a number of ways of doing this. The most recommended way that I recommend is placing the stop losses above the price action plus 10 pips for a bearish signal. And this is very low risk. Be aware that the candle must have, of course, touched the 50 to 61.8 first. Now, when it touches the 50 to 61.8, remember how I went over concepts of entry just before? We want to see the price break below as well before we take an entry. So let's have a look at this as an example. Price was coming down, so it's a downtrend. Okay, we've created a new lower low. This is a structure zone 2. Price pulls back to this zone, and you can see we've got a bit of bearish price action, 61.8. We did get a bit of bearish price action at the 50%, but as you can see, price did not break lower. Okay, what I mean by break lower is below the wick. You place an entry. Yep, just a few pips. It can be up to 9 pips below, depending on the time frame. Higher time frame, you want to give it a little bit more pippage, right? Lower time frames, you can just do a few pips, the entry below the wick of the bearish candle. Okay? If you're just trading a normal candle. Same goes with all the other candles as well. You much prefer with this sort of standard of strategy to enter below when it's a bearish candle. Okay, it's much easier and you have the benefit of hitting other people's stops in the process. So as you can see, price came up here. We've got a nice bearish candle at the 61.8 after it hit it. If you entered just below the 61.8, you could have placed a stop loss here quite tight, and then the risk reward was quite nice. You take it down to here as the money management. Of course, you take it to a 1-to-1 as we go over in the Engulfing Trader series. And then you take it to the current low, which was the previous low, and then we start tightening our stop at this zone. We can also take off the remaining positions when it hits this double bottom area as well. However, if holding on to positions is highly recommended, and then that way when the market keeps continuing in the trend, we can get more profit overall. Alright, so let's go into another example. Where to place stop losses. Now this is a bullish example. Price is confirmed it's an uptrend, right? So placing stop losses below the price action, right? plus 10 pips for bullish signal is very low risk. Be aware that the candle must have touched the 50 to 61.8, of course, once again. And as you can see, we've got some nice bullish price action in here. And in fact, it's a little bit of a double bottom, isn't it? Right? Now we've touched the 61.8 in between the 50 to 61.8. It's confirmed as an uptrend, and then the price went up. Right, and now we're just placing stop losses below. Now there's multiple confluences here as well, like I just mentioned before. There's structure, and there's also candlestick price action as well. However, the key factor is that it touched the 50 to 61.8 zone, which is the highlight in this series. All right? So stop losses don't have to be massive. Now, if you are placing orders, just placing an order in this zone, then you would have to place your stop loss below the previous low. Right? Okay, this is the recommended place to place your stop. Okay, is just below plus 10 pips. Below the price action plus 10 pips. And it gives a very, very high reward to potential risk amount when you are right on the trade. Like I said, we're not going to be right all the time. We're going to be right the majority of the time. And that's all we're after in trading. Where to take profits. As recommended in the Engulfing Trader, taking profit should be divided into two parts. First, never risk more than 2% per signal. This can be adjusted with position sizing. Then open up 2 times 1% risk trades. First trade should go to 1-to-1 risk to reward, as recommended in the Engulfing Trader. Second trade should be locked in at break even once first profit has been taken off and allowed to run until the opposing price action suggests to close or opposing major structure. Right? So on the trade that we allow to run, we like to see candlestick price action either suggesting to get out or we're coming up to an opposing major structure. Now the benefit of waiting for some good opposing price action suggesting to get out is it means we can allow the trend to run as long as possible. Right? And these are two of the standard methods that work really, really well. Of course, you can just lock in. And that's the same as allowing the price action to suggest to stay in. Right? Okay. Where to take profit. So let's look at an example. As an example, signal pin bar entry. 5 pips above at fib and structure zone. Right? And it's good. 5 pips is a bit of an even handle. Bit of an easy number to work with. Just place an order 5 pips above once you get the price action. You always want to see the market go higher than the candlestick that your signal came from. First trade, take profit to a 1-to-1, right? And second trade set to break even and then closed on good opposing price action and break lower. In this example, it breaks lower at the bearish engulfing candle, which you can see here. So first took to a 1-to-1 here. Right, and then second moved along sideways for quite a while, and then finally we got a candle that looked like it was going to go lower. Now in this instance, market kept going higher. That's okay. Sometimes it does. And that's why sometimes, you can give the market a little bit more room to see what happens when it breaks below. But in this instance, following the rules, we would have gotten about a bit over a 2-to-1 on this position, which is not bad, right? Not bad at all. But as you can see, the market did keep going higher in this example. And there's a good reason why I wanted to show that example of the market going higher. Is because sometimes we think that we're getting out of the right position and the market can go higher. Right? But by following the rules, it allows us to get good reward. Okay? And like I said, if you were going for the opposing structure, well, the opposing structure was up a bit higher. Okay? So sometimes the candlestick price action can mean getting out earlier. Sometimes it can mean getting out later. Okay, so there's a bit of a benefit in both ways. Here's another example. Now this is another example with candlestick price action for exits. And these are the sort of examples where, they show the potential of what can actually happen. Okay, so let's have a look at this. As an example, signal bearish engulfing entry 5 pips below at fib. What I mean by fib is the 50 to 61.8 and structure zone. We've got this structure zone drawn in here from the past. First trade takes profit at a 1-to-1. As you can see, this is a 1-to-1 zone. Second trade set to break even and then close on good opposing price action and break above. That's an important one too, is you always want to see when you see the reversal candle, you want to see the market break above. Because if it doesn't break above, that can mean it's just a little tiny bit of a bullish reversal in a downtrend, and you want to keep holding on. In this example below being the bullish engulfing, and as you can see, here's the bullish engulfing down here, and the market went down here. So second exit on break above, in this case of bullish engulfing break above. About a 5-to-1 risk reward on second position. So these are the sort of trades that build your account. A great trend trade. And as you can see, the market started to go a bit sideways down here and probably pulled back again and then gave another move to the downside. All right? So this is an example of how the price action can get you more pips sometimes than looking at the opposing structure. So this would have been the opposing structure, just at this current low right here. And in the previous example, it showed that using price action was not as beneficial as, so sometimes either or is better, or sometimes using a combination of both, right? The choice is yours. As long as you are getting more than a 1-to-1 on your first position is going to a 1-to-1, and then you're using good reasoning to get out of your position, such as opposing structure or opposing candlestick price action. They are great ways to manage a trade. Okay, let's go on to the next one. Okay, money management. All right, Fibonacci can be used as a way of taking partial profits. However, I've found that it is much more effective just using for entries, right? And this also helps keep it simple as well for everyone here. For money management, therefore, we focus on what we went over in the Engulfing Trader series. Okay. However, let me sum that up for you once again. Money management. Risk 2% per signal, or in other words, 2 times 1% risk trades. Now that's 1% of your account, people. Now you can do this with position sizing, and there are a number of position sizing tools out there. However, you can work it out with a simple calculator as well. Right? So you just times your account by 2%, and then just halve it for doing 1% risk trades. And then so what we do after that signal is we allow first trade to target a 1-to-1, such as what we go over in the Engulfing Trader, risk to reward, and then allowing the remaining trade to then be locked in at break even, and then allow to run to opposing candlestick price action or to opposing structure before taking profit on their remaining position. Well, thanks for watching part 1 and part 2 in the Fibonacci retracement training series. In order to proceed with your training in this series, what I recommend you do now is jump onto the time frame examples included in the series, such as the 1 hour, the 4 hour, and the daily time frame. On the time frame examples, we'll be going over on those charts how to use the Fibonacci retracement tool on that chart. Well, thanks for watching everyone, and I'll see you in the next video part. Bye for now.